Section 2, money laundering. Money laundering is a commonly examined part of P7, and you're encouraged to know the jargon, but also you're encouraged to be able to spot where money laundering might be an issue for a particular company in a scenario. Now, I would say that in any question on money laundering, a good starting point would be to start with a definition of what you consider money laundering to be. And so here's a good definition right at the beginning of the section here. It's the process by which criminals attempt to conceal the true origin and ownership of the proceeds of their criminal activities. It's essentially a way of turning dirty money into clean money. Now, given that definition, we are talking about a crime. So we tend to see things in the real world, such as people that sell drugs, or perhaps that are gun runners, are involved in the arms trade, these illegal activities, which are often very lucrative. And so imagine you're a drug dealer and you have an excellent reputation for selling drugs and you make lots of money. What you have to do is make sure that you can account for that money, so that if anybody ever says to you, where did all this money come from? You clearly can't say, well, I'm an excellent drug runner. You have to come up with a reason or an excuse as to the source of your funds. And that's what money laundering is all about. This idea of, if you like, proving falsely where this money came from. Some people suggest that the very term laundering comes from activities carried out by the mob in the Americas in the 1920s, and that many gangsters in the 1920s were using businesses such as laundrettes to take all of their illicit funds and then were able to use a legitimate business as the excuse, as the reason for where all this money came from. But that's by the by. Essentially, it's about concealing the true source of the proceeds of your crime. Now, it's worth pointing out that internationally, for the last few years, there has been an international task force, the rather intriguingly named Financial Action Task Force. We don't need to know much about them, but they are a global organisation who have made over 40 recommendations as to how local governments can help counter the crime of money laundering. Now, over the page, we just offer up some jargon. There are essentially 3 stages in the money laundering process. So let's have a look at these 3 steps in the money laundering process. First of all, placement. This is putting money into financial products, such as a bank. So imagine that you've just made £1 million or $1 million from your illegal activities. Clearly, it would be inappropriate to walk into a bank with a suitcase full of notes saying, "Phew, that was a busy night. Can I please deposit £1 million?" Immediately, the bank will be suspicious and say to you, well, where did all this cash come from? So it would be inappropriate for you to walk into a bank with a suitcase full of money. You need to be a bit cleverer than that. So what you tend to do is you'd have to split it up. And in fact, there are legal limits in every country whereby if you try to deposit more than a certain amount of cash, you'll be legally required to prove your identity, and you'll be asked where the source of that money came from. So let's say, for example, that it's £10,000. If you're depositing more than £10,000 cash in your bank, then you'll have to go through certain checks. So what you'll have to do is you'll have to split all that money up, and you have to get walk into the bank several times with £9,000, let's say. Now, of course, that's going to take a lot of time and effort, but you don't want to arouse suspicion. So you've got the money into the banking system, but at some point you want to be able to spend that money on a large house or a Ferrari or a work of art. So again, at some point you are going to have to justify to somebody where this money came from. And this is where we have to create a series of transactions in the process known as layering. Now, this could be using things like offshore bank accounts or front companies. And what we were doing here is we'll be creating a series of invoices, bank deposits, bank withdrawals to muddy the waters. Really what we want to try to do is create such a layer of transactions that it would be virtually impossible for somebody to work backwards from the purchase of a large house and then determine the actual true source of the funds. So, for example, often in the Hollywood films, we'd see things like offshore bank accounts in the Caribbean, or in the United Kingdom, perhaps in the Channel Islands, where no questions are asked about where the money came from, and there might even be legal restrictions as to who can access the data relating to your bank account. Then, once you're satisfied that the money can't be traced to your illegal activities, then you can actually start buying things. Houses, cars, Ferraris, works of art. And the idea then is that this is coming from a legitimate bank, so perhaps you might transfer the money out of your Caribbean bank into your local home bank. And if anybody ever asks you, how on earth can you afford this Ferrari? You could potentially say, well, the money comes from my business. Typical businesses tend to be cash businesses like casinos or betting shops, or perhaps even football clubs. Who knows how much money laundering is going on in the English Premier League. But the idea then is you've got a business to be able to justify, well, business is good, it's generating a large volume of cash, and that's how I can afford to buy these large assets. Now, as well as the actual buying and selling of the illegal goods, drugs or whatever, there are other criminal offences that the Financial Action Task Force are interested in. So certainly the obvious one is what we were just talking about. Using the proceeds of criminal activities to ultimately buy goods. But it also covers things like tax evasion. Not paying the legally required amount of tax to your local jurisdiction. Also bribery, corruption. By definition, we're talking about individuals that haven't necessarily got a good moral code. Aiding, counselling or concealing such activities. So again, if you're not the one actually buying or selling the guns, as long as that doesn't really matter, as long as you're involved in the business and you're aware of that business, you're as guilty as the party actually physically buying and selling the goods. Failure to disclose knowledge or even suspicion of money laundering. Now, this is a particularly important point for accountants. And as far as this paper is concerned, it's probably the one that you're most likely to come across in the exam. I'm going to come back to that point in just a moment. Also, the idea of tipping off. If you're not involved in the actual activities of buying and selling guns or drugs, but you have a friend or an associate that is involved, and you hear through the grapevine that they're about to be investigated, if you then tip them off, i.e. let them know, the law is so wide that it would consider you as guilty as them. So don't tip them off. But let's just go back to this idea of failure to disclose knowledge or suspicion of money laundering. Imagine you work for a firm of accountants, perhaps in the audit department, and this is what's most relevant for the P7 exam. If you come across a relatively unusual or suspicious transaction, for example, your client approaches you and says, I'm having a bit of trouble with my bank and I'd like to put some money in the bank, but they're having a few difficulties with their computer system. Would you mind just holding on to £50,000 for me, just for a couple of weeks, until my bank sorts out its internal computer problems? The idea of professional skepticism comes in here. As an auditor, you're not meant to be financially naive. And so we do see questions in the exam where clients, for example, say, oh, you must have a nice safe office. I've just bought this work of art. Would you mind holding on to it for a moment for me? For a week or two, or a month, or a year. I'll pay you for it, but as a firm of accountants, surely you've got a nice, secure office there. Would you mind looking after this piece of art? Again, don't be just put off by the fact you're going to receive a fee for looking after this. Think, well, hang on a minute, isn't that a bit unusual? And if you don't disclose this suspicion to somebody relevant in your firm, and we'll talk about the key person in a moment, but it's probably going to be an audit partner or director in your firm, then you could be considered as guilty as the parties involved in the illegal activities. Now, this is an important point for any practicing accountant. Let's be honest, most people sign up to be an accountant so you can have a nice standard of living, live in a nice house, and have a good future. What you didn't sign up for was the potential for being fined or potentially even imprisoned because you weren't aware enough of potential money laundering activities. So this is particularly important. And what we'll tend to see in a second is that firms of accountants need to train their staff in the importance of spotting where money laundering might occur in their clients. In terms of ethics, well, in most countries in the world, money laundering is a crime. But there might be some out there where it's not a crime. So regardless of the legality of money laundering, the idea that as far as accountants are concerned, you should be aware of the fact that committing any crime is something which should be reported on. Now, by its very nature, money laundering is an attempt to conceal the true origins of the source of funds. So this is not going to be an easy job for many accountants. Again, you're not going to come across, Mob and Co. in the exam. It's not going to be that obvious. It'll be a company which perhaps might just be a bit naive. In fact, it might even be the client which is not involved in money laundering, but has been approached by one of their associates to perhaps look after a piece of art. So again, the auditor has to be quite aware of any of the implications of money laundering on their work. So when you train as an accountant, whether it's for a firm of accountants or in the accountancy department of a company, you should receive training, let's say, as to what money laundering is and how to spot it. What if you are a firm of accountants? Let's not forget that one of the ethical codes when you're performing, let's say, an external audit is the duty of confidentiality. i.e., if you discover anything in your client's work, of course you shouldn't go and tell that to any third parties. So how does this tie in to money laundering? Well, can you override this duty of confidentiality? And if so, to whom do you disclose any suspicions of money laundering? Well, we'll come back to this over the page in a moment, but the short answer is yes, you can breach your duty of confidentiality, even if you're just suspicious of money laundering. So we'll come back to that. Also, whenever there's a change of professional appointment, let's say a new auditors, again, you might recall from F8, you always have to say to the previous auditors, is there anything I need to know about before I accept this new potential client? You might also recall from F8 that you should never accept an appointment of a new client until you've received that clearance from the previous firm of auditors. And if the client, for example, doesn't give you permission to contact the previous firm of auditors, you should automatically reject the potential engagement. So what can accountants do to meet their obligations with respect to these money laundering rules? Well, essentially what you've got here is some practical points which could come up in the exam in terms of what can companies do to minimise the impact or minimise the chances of not spotting money laundering or not being affected by a case of money laundering. Well, in the United Kingdom, we are subject to European laws. Now, it's fair to say that you don't have to be studying in the UK for this paper. I suspect that the majority of you listening to this lecture are studying in the UK, but it doesn't matter. You could be listening to this anywhere in the world. There will be local regulations that you face surrounding money laundering. For example, European law dictates in the United Kingdom we have certain obligations. Now, even though you won't specifically be tested on, let's say, UK or European rules, what you've got here are what you might consider best practice that could be applied to any question in P7, regardless of where you're actually studying. For example, a firm of accountants should put some controls and procedures in place to make sure that the firm is not used for money laundering purposes. This would involve senior management having things like training courses. I think it's fair to say that if you work for a firm of accountants very early on in your accountancy career, or indeed if you work for a firm just in an accounting environment, again very early on in your career, you'd at the very least be given a leaflet, but more likely be given some training on the importance of spotting potential money laundering for your clients or indeed for your firm. The reason for this, as we'll see a bit later, is that if you are considered guilty of not even reporting the suspicion of money laundering, you and your firm could face a fine and potential imprisonment. Now, there aren't many things that you study as an accountant in your professional exams where if you get something wrong, you'll go to prison. This is a big deal, and therefore if you work in an accounting environment, particularly if you work for a firm of auditors, it's likely that early on in your career you'll receive some training at the instigation of senior managers. Also, I imagine that your firm has some sort of money laundering reporting officer. This is likely to be somebody fairly senior in your firm, a partner or a director, who will insist that any suspicion or actual involvement or spotting of money laundering should be reported to them, even if it's the slightest suspicion. They'll say, look, don't worry, don't be embarrassed, even if it turns out not to be money laundering, please report it to me immediately. Keeping appropriate records for your clients. So no conversational auditing here, but actually getting photocopies of key documents, including things like the identity of your client and its key staff. So a very common audit test nowadays is to get photocopies of the key client staff's passports. Are they who they say they are? Or are they in fact the jackal, a key money launderer? Likewise, is the company who they say they are? So again, you'd have to go to company's house and get the relevant details, their financial statements and their annual reports, to make sure that the company is a bona fide business. And as we've seen, make sure that your staff are aware of the importance and the scope of money laundering. Interestingly, just this final section here on the Financial Services Authority. Again, this could be a local body, largely dealing with banking transactions. Even if you're not an accountant, even if you're not a trained ACCA accountant, the idea here is if you are involved in any aspect of money laundering, then again, any non-compliance could lead to action being taken against you. Court action, fines, potential imprisonment. The idea is the banking authorities want to throw this money laundering net as wide as possible. If you are a member of an institute such as the ACCA and you are found to be guilty of negligence in this respect or guilty of the criminal act, then you can certainly expect to be chucked out of the institute. And what you'll tend to find is if you think, well, that's okay, I'll just go and join another institute, you'll find that all accounting bodies around the world, or all decent accounting bodies anyway, have this sort of pact, if you like, whereby if you're chucked out of one institute, you won't be welcome in any other. So the idea of knowing your client, sometimes referred to as customer due diligence, you can't use naivety as a claim of defense in a court of law. This applies to new and existing clients, so just because you've been auditing a firm for a while, you shouldn't let your guard down. In fact, you could argue that the less independent you are, and you could argue that if you've been an auditor of a firm for several years, you might have your guard down a bit. It might be that then your client thinks, well, okay, these guys know us and trust us now, so perhaps now's a good time to throw in a few suspicious transactions, and we can say, look, no, trust us, you've been auditing us for years, surely you don't suspect us of anything. So again, it's not just new clients that this arises for. Final bit of jargon in this section, politically exposed persons. Occasionally in the exam, not that often to be honest, but occasionally you come across a politician or somebody who is involved in local government. All you need to be aware of is that from an audit point of view, any transactions that your client have with politicians or anyone with a public a role brings their own reputational risk. So any transactions, for example, with politicians should be subject to particular scrutiny because of the very public nature of this person's role. Now, this may or may not have anything to do with money laundering as such, but the idea is there is greater risk attached to such individuals. Not a big deal, but just being aware of the term politically exposed person. So just keep your eye open for any politicians and any questions. And all you have to say is, in your answer, well, this is a politically exposed person, which increases the risk of the audit because of the public nature of this person. In the final section of this chapter, and covered in the next lecture, we'll look at laws and regulations.